Alec Walker with Crestmont Private Wealth. Today, I'll be discussing a tax concept called net unrealized appreciation, or NUA. After watching this video, if you have any questions, please reach out to our team, and we'd be happy to schedule a time to have a conversation with you. Now, NUA is defined as the fair market value of employer securities distributed over the cost basis of those securities within a plan. After a triggering event such as turning age 59 and a half or separation from service, a participant has the ability to elect NUA with a full distribution of those assets from a retirement plan. Now, the employer securities, the holdings that you're electing NUA with, they cannot be rolled over to an IRA. They must be distributed to a brokerage account. The tax complexities, the timing, compliance with the NUA rules is why this is a very complex decision, and sometimes it doesn't end up being as good as it sounds in theory from a tax savings perspective. So how NUA works, as I mentioned, the cost basis, so how much you or the employer paid for those company securities when contributed to the plan, that is going to be taxed at ordinary income in the year that NUA, that distribution, is elected. The NUA portion does not have to be sold immediately, and it will always be taxed at long-term capital gains rate. And then you've got the post-NUA gain or loss. So once distributed, if you decided to hold those securities for multiple years, whatever gain or loss was added on top of the NUA, that would be taxed separately from the NUA portion. Now let's look at this with actual dollars and cents. So let's say that with XYZ stock, the average cost per share when this participant was retiring was about $25 per share. They had 10,000 shares, so the total cost basis was $250,000. That XYZ stock has now grown to $100 per share for a fair market value of $1 million. Now, if they elected to retire and do a full distribution of the plan and elect NUA of all the shares, that $250,000 would be immediately taxable as ordinary income in that year. The $750,000 NUA portion will always be taxed at long-term capital gains rate. They could elect to diversify that immediately or hold it into the future. And then whatever post-gain or loss above the NUA portion, that would be taxed separately. Now, this does sound in theory as a good tax saving tool, but many times the timing of the tax implication, the rate that you would actually receive on long-term capital gains, whether it's 15, 20, or 23.8%, depending on what your taxable income is, can outweigh the potential benefits of diversification and maintaining that tax-deferred growth within a retirement account. So again, if you have any questions to see if NUA makes sense for you, please reach out to our team. We'd be happy to schedule a call to go over this with you, as it's very specific based on each individual's situation. Thank you very much.